morning, everyone. We're back from our overnight recess in our meeting, so we're not exactly calling the meeting to order because we just had a recess of it, and we'll let the roll reflect that all of the members are present. I'm so pleased to say that we have a really substantial hearing to start out the day on the situation of insurance in the state of California. And I'm very pleased the leadership that the vice chair has taken in putting together a very impressive roster of speakers for us and of finding the key people to provide us with the answers that our constituents need. The insurance crisis is affecting each of our districts in different ways. But there are many commonalities, and it is really part and parcel of the success of our state to make sure that we are apprised of what is going on with the insurance markets. And so I'd like to invite my vice chair to take the virtual gavel and to proceed with our hearing. Thank you.
Thank you, Madam Chair. I appreciate it, and appreciate the opportunity to bring this forward in terms of kind of the critical nature of property insurance in the state of California today. Years ago, when I was in the state legislature, I started to get a trickle of calls from rural homeowners who complained that they were getting dropped from their homeowners insurance and could not get new coverage, or the coverage was very expensive. These calls became more frequent over the years, and now this problem with property insurance is spilling out into every corner of the state. As you will hear from our presenters, our lack of affordable insurance is affecting every aspect of property in California, making it more difficult to build, own, and sell. This will have a dramatic effect on property taxes over time as it changes the number of home sales or tamps down the prices buyers are willing to pay for properties. California property insurance is governed by Prop 103, which was approved by the voters in 1988 and was intended to protect consumers, although it's unclear if it's really living up to its purpose given the crisis that we're in now. We face extraordinary wildfire risk, which has resulted in some staggering losses of property and life in the past decade, and which has wiped out decades of insurer profits. The numbers I'm hearing is up to $100 billion paid out in claims since 2017. The BoE co-administrators and gross premiums tax on insurers and also oversees the property tax matters. Property taxes cannot fail to be severely impacted by changes in property prices or changes to real estate market liquidity, partially driven by skyrocketing insurance costs. We have a varied agenda today, and we'll offer many perspectives on California's insurance market and how it affects many areas of California's real estate economy. I want to thank all the participants for sharing with their expertise today. Why don't we just move on to the next segment here. And I'd like to go ahead and introduce our first speaker of the day, and that is Mr. Michael Martinez, who is the Chief Deputy Commissioner on behalf of the Honorable Ricardo Lara, our Insurance Commissioner, and with the California Department of Insurance. So thank you, Michael. I appreciate you participating and giving us an overview in terms of what's happening with the property insurance market in California and the actions that are taken by the California Department of Insurance.
Thank you. Good morning, Chair and Vice Chair and members of this California State Board of Equalization. Michael Martinez, Chief Deputy Commissioner here at the California Department of Insurance. Here on behalf of Insurance Commissioner Ricardo Lara, and he sends his regards and that he was not able to be here today given other important meetings pertaining to wildfire that he has on the schedule for today. That being said, I was invited to this informational public hearing to provide an overview of the Commissioner's sustainable insurance strategy. And actually, I am, of course, providing virtual testimony. I did provide a PowerPoint. I'm presuming that it is there in front of you. If not, if Vice Chair or Chair can let me know if the, okay, there we go. Thank you.
Yeah, it looks like they're getting it. Thank you.
Okay, perfect. All right.
Hold on.
So yes, no worries. I'll just hang tight.
All right.
Okay.
Is that page
And
one
then
that we're looking at, or?
Yes, perfect. And then we will, if we can jump to the next slide, slide number 2. All right, thank you.
There we go. Looks like, yeah, we
Thank
can
you.
see page 2. Thank you.
Perfect. Thank you very much. All right. As you all well know, California is at an insurance crossroads, and for many Californians, this is an insurance emergency. From people, and of course you all as well on the Board of Equalization, who are paying more for home insurance if they can even find a company who will write them a policy, especially in the wildland urban interface, which all of your districts encompass parts of the BoE, or the wildland urban interface. This is the direct result of growing climate threats, historic inflation, and outdated regulations, among other major global and economic climate issues. Commissioner Lada's #1 priority since day one has been to protect consumers. Again, his #1 priority is to protect, includes safeguarding a robust and thriving insurance market. And our market is under unprecedented stress, unlike anything we have experienced in the more than 35 years since voters established our current system of insurance regulation under Proposition 103. Last September, Commissioner Lada announced his sustainable insurance strategy, which is the largest insurance reform since voters passed Proposition 103. There is no question that the risks that existed when voters passed Prop 103 are not the same risks we are facing today. Decades of global warming are colliding with our state's growing population to put people directly in harm's way, while we are making massive changes to how we build smartly and proactively prepare for wildfires. We must also change how we regulate the insurance industry. Put simply, we need new tools to deal with new problems. The insurance market we are dealing with today necessitates urgent measures that Governor Newsom also recognizes as set forth in his executive order issued on September 21st of last year. The governor's executive order supports swift regulatory action by the Department of Insurance to strengthen and stabilize California's insurance marketplace. The sustainable insurance strategy is based on a thorough assessment of today's insurance landscape, with input from wildfire survivors, ranchers and farmers, supportive housing groups, realtors, homeowners and condo associations, new home builders and property owners, among many other insurance consumers most affected. Next slide, please. In the coming months, we will implement at the Department of Insurance lasting changes that will make Californians safer through a stronger, more sustainable insurance market. As I will discuss in greater detail, our strategy consists of the following main components. Firstly, streamlining the rate application and approval process. Secondly, introducing new risk management tools that recognize catastrophic modeling and California-only net costs of reinsurance, with a commitment from insurance companies to write at least 85% of the homes and businesses in distressed areas of the state. And thirdly, modernizing and strengthening the state's FAIR plan. Next slide, please. The changes to California's market have been sudden, but they are decades in the making. Over the past 12 years, 7 of the top 12 insurance groups in California paused or restricted new homeowners business in the past year. These insurance groups represent 85% of our state's marketplace, so these actions are having a significant impact across our state. At the increase their rates under our existing regulations. Over the past year, major companies, including State Farm, Allstate, and Farmers, among many others that you see here on this slide, have applied and received significant justified rate increases, as you have also seen publicly reported in the media or read in the news. Under existing law, insurance company rates must be adequate to pay future claims while covering expenses and allowing for a reasonable rate of return. The department follows a rate review formula that puts clear limits on profit-taking, executive pay, and advertising expenses while allowing insurance companies to set department-approved, justified rates appropriate to cover their future losses. Yet even with these rate increases, insurance companies are still no mandatory requirement under Proposition 103 for insurance companies to write policies. Let me please underscore this point. Under our existing regulations, consumers are paying more with no promise that they will have a competitive market in the years ahead. Insurance companies, interveners, and the regulator share this responsibility. The department is meeting its responsibilities under the current regulatory structure, but that is not enough to market crisis. Past decisions kick the can down the road. We are at the end of that road. Next slide, please. There is another cost of our shrinking market. Insurance company actions have pushed more Californians to the FAIR Plan, which has become the only option instead of the last option. The FAIR Plan has grown 20% this past year alone, now at more than 330,000 residential policies. The FAIR Plan, I believe, will be testifying later in this public hearing, and they can, of course, provide more up-to-date information on their policy growth. For most, the FAIR Plan is limited coverage at a higher cost. FAIR Plan coverage contributes to the problem of underinsurance, leaving people at greater risk of paying out of pocket in a disaster. And a growing FAIR Plan poses a problem for all Californians, even if they have never heard of the FAIR Plan. Put simply, increasing the number of policies in the FAIR Plan threatens the solvency of our entire voluntary insurance market. By law, if the FAIR Plan experiences a massive loss and cannot pay its claims, insurance companies in the admitted market are on the hook for the unpaid losses. While this assessment on insurance companies hasn't happened in nearly 30 years, this uncertainty is also driving insurance companies to further limit coverage to Californians at greater risk to wildfire loss. This is why our strategy focuses on increasing insurance availability while reducing the and on California consumers. We must reverse this trend of a growing FAIR Plan if we are going to safeguard the state's insurance market as a whole. All the components of the sustainable insurance strategy are the result of examining the current regulatory structure and acknowledging the challenges of addressing the current market crisis given present day constraints. The goal of our strategy is to strengthen and improve our current regulations to meet our present needs. The changes that Commissioner Latta is proposing are transformative. The department is working under an ambitious, which allows for public input and transparency, given that we are public entities as well as you yourselves at the State Board of Equalization, yet also allows little room for error. Now I want to discuss the components of our strategy in more detail, starting with the rate application review process. Next slide, please. California law is clear. Insurance companies are free to propose rates at any level. There is no maximum. The department's rate review is the public's check on their rates, and we thoroughly review each and every rate filing to make sure they are compliant with our laws, justified, and consumers get the best value for their money. Yes, the public is granted a role to intervene in the review of rate filings. The reality is that interventions only take place in a handful of cases each year and primarily by one organization. Interventions can, by and large, delay the rate review process. Over this past year, one organization intervened in 18 major rate applications, signing off on higher rates while simultaneously receiving fees for doing so. The same organization supports various department activities and received compensation of over $9 million passed on to consumers and the public over the past 10 years. However, it is the department's rate regulation experts who are there day in and day out and lead each filings process. To put this in perspective, we currently have 95 homeowners rate filings on our plate and 75 auto insurance rate filings. Just some of the thousands of filings we review every year. Not all of them are rate filings, though. That does sound like quite a voluminous amount of filings, but we have a series of quite an array of filings. The rate filings, the ones that pertain to premium and rate, are the ones where that we give a lot of attention to, and so do the insurance companies and interveners. We are focused on strengthening the department's rate regulation branch so that we can meet the continued growing demands of rate applications submitted to the department. And the rate regulation branch is one of several branches, but they are the ones who are, again, the experts who review and approve all of these the rate applications, the rate filings that come into the department. When market conditions change rapidly, we must do our part as a regulator to protect consumers' access while working to meet statutory deadlines. The department is presently hiring more analysts, actuaries, to strengthen our intake and review processes while we are busily putting together a rate reconciliation tool. We will also be introducing new regulations that improve all areas of rate review. This process extends beyond the department. We expect all participants in this process, including insurance companies and interveners, to work with us towards improving our review and approval of rate filings, which is an essential part of how we keep insurance available in our state. From insurance companies, we intend to enforce the requirements that a complete rate application is submitted to the clock on reviewing the application begins. In the past, we've allowed insurance companies to submit their applications without the complete data needed. But today, we don't have the luxury of time for a lengthy back and forth about incomplete applications. We expect insurers to provide the department with the complete information upfront needed for us to make a determination on the requested rate. And the department will also provide a rate reconciliation tool to assist with that. And further, Prop 103 timeline guidelines that were put into statute, again, more than 3 decades ago. Shortly after announcing the strategy, the department reviewed its rate application intervention process. We have streamlined the intervener process administratively in rate applications to provide greater clarity, efficiency, and transparency. We'll continue to look at and release regulations to that effect as well. Third-party interveners are only allowed to raise issues that are directly relevant to a specific rate application. Raising unrelated or irrelevant issues only serves to slow down the process, which has a direct impact on consumers and insurance availability, especially when there are other avenues to raise these issues. Moreover, all intervener petitions, as well as how much compensation received for intervention, are now posted on the department's website. Overall, the goal of a more streamlined, efficient, and transparent approach will better represent the interests of California's consumers. Next slide, please. Allowing new risk assessment tools that can support greater availability of insurance. For the past 30 years, the department has used historical losses as the method for estimating catastrophe adjustments in the rate review process. Put simply, insurance companies look to past experience to predict future losses. However, historical losses do not account for the growing risk caused by climate change. What's more, this approach is directly contributing to the growing cost of insurance, as record-setting losses fuel higher rates with no allowance for our collective efforts to reduce risk through home hardening, prescribed fire, and healthy forest projects. There is a better way, and that is through the use of forward-looking models in light of the growing threat of climate change that can be thoroughly reviewed and justified. The department has been engaged in ongoing conversations and public workshops with the public, academia, insurance companies, and consumer groups regarding the use of catastrophe models in the rate approval process. The use of catastrophe models will be informed by California's goals of fairness, transparency, availability, and affordability. We recognize that time is of the essence, but this is not something that can happen overnight. The process of incorporating catastrophe models into California's complicated one, and it will involve and is involving multiple branches of the department working together on the solution this year. Next slide, please. Reinsurance. Reinsurance is an increasing expense incurred by insurance companies as part of the cost of writing home and commercial policies. Insured natural disaster losses have increased 5 to 7% annually for the last 30 years, and insurance companies are taking on more reinsurance to cover these increases. Our analysis shows that reinsurance is an important component of how insurance companies in turn manage their risk, enabling them to write policies despite these growing threats. Yet California is one of the nation that does not presently allow insurance companies to recover this reinsurance expense. This contributes to insurance companies' decision to reduce new policies or to restrict writing in our state to just the lowest risk policies. This is why the department is examining how to allow insurance companies to recover their California-only net cost of reinsurance in their rate applications filings submitted to the department for review and approval. Our goal is for consumers to have insurance options. We seek to allow insurance companies to recognize and recover their California-only net cost like that in their rates. This will encourage carriers, we believe, to re-enter and expand their business in the California property market with rates that more accurately reflect the cost of doing business in California. Insurance companies will not return to California unless they are able to charge rates that are justified to cover their risk and provide the opportunity to earn a fair return. Commissioner Lott has been clear that increasing availability of insurance is how we will protect affordability. We need to focus on getting insurance companies back to writing policies in California and to a point where they are competing for consumers' businesses. As the largest insurance market in the nation, California's insurance rates are far lower on average than in many other face growing risks from climate change, particularly hurricanes on the East Coast and Gulf Coast. Most importantly, the two risk assessment tools that I just discussed, catastrophe modeling and reinsurance, are because to use them to set future rates, insurance companies must satisfy two commitments. The first is that they must increase writing in our state, at least 85% of the homes and businesses in the distressed area. Secondly, that they must help depopulate the FAIR Plan. So in other words, lift FAIR Plan policyholders that are in the FAIR Plan today, lift and shift them back out of the FAIR Plan and into the admitted market. These are essentially mandates, we'd say, but ones that we can monitor over time and enforce when needed if an insurance company decides to and wants to utilize CAT modeling and or reinsurance in their rate filings and in their rates to ensure Californians have access to insurance while insurance companies stay in our state and expand their reach in our community statewide. Insurance companies that cannot meet this commitment will not be able to use either CAT modeling and or reinsurance as part of the rate application. Insurers that fail to follow through on their commitment will have their rate reassessed by the department as part of just our job as the regulator. Next slide, please. FAIR Plan, it will still be a temporary option in the short term for many Californians. While Commissioner Lott has made many reforms to the FAIR Plan since he first took office in 2019, such as increasing the FAIR Plan's commercial coverage limit to 20 million per location, we need to make further improvements to the FAIR Plan so that it can serve its legislatively intended purpose of creating stability in the property insurance market while providing consumers with the best possible consumer service. There are more changes needed to the FAIR Plan. Some Californians need more coverage than the FAIR Plan currently provides, particularly our homeowners and condo associations and home builders. Thus, we will be working to increase coverage for our larger homeowners associations, condo associations, farms, and other businesses, such as further increasing that commercial coverage limit at the FAIR Plan to 20 million per building. Next slide, please. Testimony. The department has a goal of submitting each of the regulatory efforts associated with the different components of our strategy throughout this year. Again, throughout this year, the goal is completion of this strategy by December 31st, 2024. Under our strategy, there is a clear benefit for consumers in areas where the FAIR Plan has become the only option. Consumers get greater insurance availability through these transformative regulatory reforms. More options mean better competition on cost and service. Again, in order to utilize the new tools that I have discussed, insurers must take policyholders from the FAIR Plan and increase their writings to at least 85% of homes and businesses located in a distressed area of our state. The conversations we had in last year's legislative session as we developed our strategy, this strategy, show we all are seeing these problems. We will continue to partner with all those who want to constructively work towards real solutions to create more resilient communities in our state and provide more insurance coverage options for Californians. Thank you.
Thank you very much, Mr. Martinez. I appreciate that great overview in terms of what's been happening. I do have a question, if I could. Is there any chance that your regulations would be ready sooner than December? My concern is that there's a crisis out here. We're hearing it every day. I just read an article in the Wall Street Journal. An insurance agent down in Coarse Gold, Yosemite National Park, quote, "There are no good days." And then he goes on to say, those days when we used to have a family walk in needing coverage, you'd write them a policy and they'd walk out happy. He said, those days just don't happen anymore. You never get to deliver good news. Every rate change is an increase. Every coverage change is a restriction. My staff and I, we've had to build up some scar tissue. And so I just can't emphasize enough the pain that our constituents are suffering. And so then I look to the Department of Insurance in terms of, you know, you've got a plan, you're implementing the plan. I appreciate the modeling opportunity that insurance companies will now use to predict cat losses, also the opportunity for reinsurance to be passed on for the the California net additional cost. But can those regulations be implemented sooner than December? Should those be emergency regs versus just a normal regulatory process?
Thank you, Vice Chair Gaines. I appreciate your question, and it is definitely a question that comes up. We've received that question in multiple avenues from a variety of elected officials and local, state, and federal. I mean, a lot of folks do inquire, and this is what I say, and this is what the commissioner and I say, is that we are, as conveyed in the testimony, these are transformative changes. We are changing how the state of California at the Department of Insurance has regulated the admitted insurance market for the past more than 30 years. And that cannot happen overnight. We want to be thoughtful. We want to have engagement from the public. These are public processes that do have, under existing law, timelines that we must hew to in order to ensure that we can, again, have a very open and transparent and public participatory process in rulemakings. Now, we are actively going to introduce emergency rulemakings with the governors that was provided last fall, that allows and gives the commissioner of the department to point to in order to impress upon the urgency and the extraordinary nature of needing emergency rulemakings, as we are exploring to have for cat modeling and reinsurance and a couple other rulemakings. And so, as I understand it, we have a whole team of lawyers and experts working on this, is that two tracks simultaneously parallel, working side by side, emergency rulemaking and a regular rulemaking process. Again, simultaneous parallel tracks.
Wonderful. That's good news.
Cat modeling, reinsurance. Thank you. Levers, Vice Chair Gaines, really, because in describing really the parallel tracks, they're simultaneously moving forward, as you said, with the cat modeling, the reinsurance, the FAIR Plan, all the rate regulation of the hiring, the retention, the contract out. There's IT fixes and programs. These are all moving simultaneously together. Some are I'd say all of them are very complicated. And so you have the internal processes to get everything ready. You have all the stakeholder engagement. You have then in turn all workshops and the back and forth and the public comments that we will receive, the voluminous. And so that is the just the world that we are operating under on or by December 31st, 2024. Now, we are not waiting for December 31st, 2024 to occur and then, all these rulemakings, if you will, get released. We are issuing rulemakings and hearings as we go. We just, for example, released one a proposed rulemaking a couple Fridays ago, and we will continue on a flow basis for public input in this simultaneous flow basis in a very urgent way. So that's one major, just because again, I again appreciate that question. If anything, again, we will stick solidly behind the on or by 12/31, December 31st, 2024, and but with the hope as much as we can get it done sooner, we will. But at least that's our bookend of wanting to get everything done. And in the meantime, in closing, in the meantime, the current rulemaking or the current regulatory process of reviewing rate filings does not end, does not stop. I myself am involved with some of these filing processes so that we can get filings in and out in order to at least have insurers continue to write or lift their finger off the pause button or expand a little bit more in this time period when they're waiting for, anxiously waiting to expand more into the BoE for the rulemakings that we are set forth to release later this year. So it's right, the current day-to-day, if you will, under the current filings regulatory structure that again we are sending on. As there was one of my slides that I showed where we are approving several double-digit rate increases that are justified under existing law to get those in and out, and in addition to all of these massive reforms that will have to and rightly should follow our public transparency and rulemaking processes.
Great, thank you. I appreciate that. If I could pose another question in terms of the wildfire risk that we have in California. We have a federal program for flood insurance. We have an earthquake authority here in the state of California for the earthquake exposure. Would it make sense to set up a wildfire fund, and that would be an add-on coverage that a consumer could add on to their policy if they're living in those areas with greater threat? Is that something that's been explored, or this seems to me that could be a solution too. There's so much pressure on the FAIR Plan, and the insurance companies are worried that they may get pulled into a big wildfire loss that could make the FAIR Plan insolvent. I think that's why we're seeing, as you explained, we're seeing some exit out of the market, or other companies that are just trying to build their reserves because they're worried about the future exposure of wildfire.
Yes, thank you, Vice Chair Gaines. I appreciate the question, and in some policy circles, when this has come up, this is what I've conveyed, is that as some of us know, that the federal flood, and we have seen with all of these incredible atmospheric river state and the ensuing flooding that has occurred, unfortunately, and again in many several parts of our state. The federal flood insurance program is running at a deficit. It does have sustainability challenges. Secondly, I do represent the insurance commissioner on the governing board of the California Earthquake Authority, and it does have some sustainability challenges as well that we are currently undergoing a very robust strategic planning and public participation process. Yes, we do have the FAIR Plan today in order to provide the coverage, wildfire coverage for those that need it. I would say that to create another separate standalone wildfire fund, it will take time to create that. Secondly, it will, in at least in having a lot of individuals who are at high, it will have a high concentration of probably the most risky properties of the state that they could, in fact, at least as it would seem in paper and in theory, would pay probably a higher or an incredibly high cost of insurance should they need it. And then secondly, and in addition, I'd say that since we have the FAIR plan here as serving as the backstop, that is our, shall we say, our safety net in order to provide the wildfire coverage insurance that individuals need. And so we in lieu of creating a separate standalone wildfire fund, because just all of these, as part of the sustainable insurance strategy, we have this strategy plan that in looking at all these solutions or all these potential solutions, that was on the table of looking at something like a wildfire fund, but we felt, okay, if we tackle the assessment, if we tackle this, okay, lift and shift out from the FAIR plan to shrink it, FAIR plan policies holders to go back into the admitted market, we felt that that would be the more nimble and more responsible way that we felt from our perspective, way to have a more solvent insurance market.
Wonderful. Thank you so much for participating and giving us an update in terms of what's happening at the California Department of Insurance. My colleagues, if you have additional questions, please. I'm sorry I dominated at the beginning there.
Yeah, thank you so much. Mr. Martinez, it's good to see you again. And
Yes.
I have several questions. My first is about the kind of life cycle of the process. I know that you have a hearing coming up on March 26th. Can you walk us through some of the steps that, as we're contacted by our constituents, we could tell them where some on-ramps to make their voice heard will be happening?
Absolutely. Is that just because of there's a lot of details, if you will, in regard to the public participation. I will have my staff follow up with the Board of Equalization staff in regard to of upcoming workshops, so that you know. And then also our community relations and outreach team is pulling together because to make sure that you all as elected officials know what's occurring at the department, because there's, again, as conveyed throughout this throughout all of my testimony and responses, is that there's a lot going on, and we believe the more transparency and more information that we can share. We do have on our homepage, we do have a link of our wildfire activities. And so we can provide that, as well as more, I guess you say, more constituent-friendly pieces that could be like, okay, this is if you want to be involved with this, here's what's happening, here's the global overview of our sustainable insurance strategy, because we in turn want to make sure that you all as elected officials have as much information as can to help answer constituent questions, and then also be able to be able to inform them of what's happening at the department so they can get involved. So yes, we are having with each public rulemaking, we will be having receive verbal comments, as well as an opportunity for written comments as well, as part of any open rulemaking process. And so there are timelines, deadlines, and so again, what I will do is I'll have staff follow up and provide your staff with more information regarding public participation.
And I have a question about the rate intervener community. What is proposed to change in the sustainable plan from what has been the role of the interveners?
So first of all is that interveners under Proposition 103 can intervene on any filing in the property and casualty space. That will not change, of course. That will not change. That has been in law of the land for the last 30 plus years as established by Proposition 103 and voted on and passed by the voters of California. What we want to ensure is that any intervening group that wants to intervene on a filing is intervening on those issues that are germane to the rate filing. Again, germane to the rate filing and not something beyond the rate filing that could be discussed in other avenues. So again, we want to have it have discussion be focused solely on the rate filing, or if not, then we move forward. We have to move forward, and rather than have a back and forth. There are many times, and again, as I've said, as I shared earlier in the testimony, that I am involved at times in some of these filings, and including intervene filings, is that we have to make sure, I've seen where conversations extend beyond the rate filing that we have before us that we need to discuss. And so there is that. Secondly, there's been a lot of inquiries, externally speaking, to the department of which filings are interveners intervening in. What are the documents that they file in order to intervene? How much are they compensated, if any, on their intervention? And so we created a publicly accessible website on our homepage that individuals can essentially, in a couple clicks, be able to see all of what any intervening group has intervened on before those filings, and the information that, the documents that they have filed to the department to intervene, and the compensation that they have received for that intervention. Timelines that we have also ensured this was done administratively, that once we are ready to go, and the we being the Department of Insurance, we have the materials and we're ready to start meeting and discussing, and the insurance companies as well. We want to also make sure that the intervening group is ready as well. In essence, and I'm trying to make it as less technical as possible, because it is a very technical, if not legal, process. When an intervening group decides to want to petition to intervene in a filing, they are essentially saying that they are ready to meet, ready to go, rather than wait several months or again several weeks in order to get a meeting on the books. We want to ensure that once everyone is ready to go, and essentially, again, the Department of Insurance and the insurance company who filed the filing, that the intervening group is also ready to go, that we cannot wait for several weeks, several months in order to get the first meeting on the books. And so that is something that we are also wanting to ensure there's accountability all around, that, again, we are ready to go when in fact we are indeed ready to go. And please know that the Department of Insurance is and should be and always in the driver's seat for its own regulatory process. And so part of this too is ensuring that the department and our department experts, who are, I'm not an actuary, I'm not a rate analyst. We have very dedicated civil service, public service positions for many years, who know what they're doing and know the rules, and will look to ensure that any rate filed with the department and in turn approved are justified. And so that's those are, again, some of the major reforms that we have pursued and will continue to pursue in this sustainable insurance strategy.
And a couple other questions. So in the plan that you have, the decision of what's germane to the rate filing, that would just be made by the department? Or would the intervener have another venue to take that to?
I mean, any public individual is able to, if they have issue, well, let's say, put it this way, is that for a filing that the intervener would have to express, this is what we want to intervene on, A, B, C, D, E, F, G. And we would, as the department, would look to see, okay, what is germane to the rate filing before us? It may be A, B, C, D, E, but I think I went to G. F and G, no, we will not be able to the rate filing. And so if there is another avenue, because it really depends on what F and G in this scenario are, if there's another avenue for outside of the rate filing review process. If there isn't, then there isn't. That is just how it works. But if there is, there could be another avenue, because we have investigations, we have other regulatory avenues where we work with interveners, and they are very helpful in these other avenues that the department has as the regulator of the insurance industry. And so again, it really depends on, again, what those other avenues are, but just the point here being is that we would want to again ensure that intervener that we are discussing those issues germane to the rate filing before us.
Okay, thank you.
If Deputy Chief Insurance Commissioner, could you hold for just a moment so that we could have a few comments from Senator Ben Allen? Because we have more questions on the DS here. If you'd be so kind. Senator Allen, how are you?
Good. All's well. Thank you very much. I've unfortunately got to run back up to the Capitol
Yes.
briefly, but I was really happy to hear all of this discussion. As you know, there was a pretty intense discussion right at the end of session where the insurance commissioner, working with a number of other parties, was trying to get a big reform measure through. A lot of politics involved, folks who were concerned about the implications to the broader Proposition 103 system, and ultimately legislative action didn't happen. But now the DOE's gone off and done this work, and I think conceptually it's very important. It's all about depopulating the FAIR Plan, trying to figure out ways to create incentive structures for folks to take the necessary action for risk mitigation that will help to solve some of the substantive structural challenges that we have with our insurance market. So I'm really happy to see it. This seems to be where most of the action is right now. I know that Assemblymember Connolly introduced a bill, but right now it's just an intent spot bill to require insurers to provide discounts to homeowners that use or install building materials and mitigation measures to harden their homes. So there's some work going on in this space. I'm sure they're going to have concerns about the way that the bill's structured. But I've been in touch with our insurance chair, Senator Rubio. We're going to be getting together next week, and I will say, whenever I come to the BoE, both here today and a couple months ago in Santa Monica, it's a good example of how this body has an opportunity to do real deep dives into some of these policy challenges that we're. In the legislature, with everyone running around like headless chickens, sometimes there's not this kind of opportunity. So I'm just glad to see you devoting a whole day to this. I mean, this is an immensely important issue. I represent an area that's fire prone as well. I've got Santa Monica Mountains are in my district. We had the terrible Woolsey fire and many fires in the past. That fire that we all lived through in 2018, I think evacuated 300,000 people, 100,000 acres burned, 1,600 homes, 3 people died. And now everybody is really struggling to find insurance, and we have to take these kinds of aggressive reform measures to shore up the industry and the market. There've been all sorts of bill. Assemblymember Friedman did a bill on establishing this ember-resistant defensible zone to both help with risk mitigation and prevention. Those are all important, but while most of the action is over in the DOI, there's definitely going to be some work on the legislative side, and we'll report back more on that. But honestly, really welcome as you go through this day and come up with ideas. We welcome your input, and I know I speak for my colleague Senator Rubio, to say how really very interested the Senate is in this conversation today, and I wanted to come down and express that. Also just to let you know, as you know, the SB 588, the affordable housing measure that we talked about back in Santa Monica at the hearing, is still alive and in assembly, and we're hoping to see if we can shake it out of the committee there. I'm also working on a big climate bond, which will actually in many respects help to address some of these big structural challenges, including on-the-ground measures to help reduce the severity, frequency, and impacts of climate-related disasters, including fires and extreme heat. And so that is a part of the insurance reform conversation. The final thing I want to say before I have to run out of here is some work that we're doing together on SB 1436 that was just introduced. I expressed this at the last hearing where we all got together in Santa Monica, but one thing that I've heard, including talking to county assessors, is that there's an access to the BoE that's really important, and that provides kind of an important outlet for discussion of tax-related matters. And we all know the Franchise Tax Board is viewed as a reliable and effective tax agency that's responsive to the concerns of taxpayers. It's the only tax agency with an oversight board consisting of elected officials. And our bill seeks to establish oversight boards for CDTFA, OTA, to consist of the controller, BoE chair, director of finance, to mirror the current franchise tax board. I know there's other efforts to try to change the makeup of the franchise tax board. I think they're, at least from what I see, misguided. But our measure seeks to increase accountability and transparency in the taxation process. And it's my feeling that applying the FTB model to other tax agencies will provide taxpayers with, and taxpayer advocates with the important public forum similar to what we have here today to discuss tax issues and policy implementation concerns. So I want to just put that on the radar screen, and happy to take a question or two, but I really do have to get back to the swing space for an 11 o'clock meeting.
Great.
Yeah.
Questions from the dais? Yes, Mr. Schaefer.
Senator,
Madam Schaefer.
we had the pleasure of you speaking to us in Santa Monica. I appreciate that very much.
Yeah, thank you. It's
And
good to see you.
nice to hear you today.
Likewise, thank you. I appreciate your work on this very important matter, and we'll be watching it closely, and I really do look forward to some conversation as you come up with some proposals. Yeah.
Just a quick question, Senator. I know you got to run real quick, but I know in your dealing, especially on the low-income housing piece, on the insurance piece, I was just wondering if you've been aware of any information on local agencies in the nonprofits world that have impacted the insurance crisis, having properties that are owned, particularly in the low-income housing arena, because I know it's been tough for them to be insured.
Yeah, I haven't done a real deep dive into this. That's a great question, and we should talk to some of our friends that we were working on with SB 588. Do you have comments on this? That's a great question. I mean, I know certainly there are massive cost pressures associated with so many things, and I can only imagine now that with the some of the challenges in the insurance market that they're seeing similar challenges. But I can't speak too authoritatively about that.
Thank you.
But it's a great question.
Other questions, comments?
Thank you. Thank you, everybody.
very
Thank you.
much,
Appreciate
Senator
it.
Allen.
And thank
Appreciate
you,
it.
Chief of Staff Martinez.
All right, great. Yeah, and, Chief Deputy Commissioner, thank you for remaining, and I believe there's some additional questions. Madam Chair, did you have additional questions? Or,
No, I think I got most of them answered. The only other one that I actually do have is, we're talking about depopulating the FAIR plan. And so under the Sustainable Insurance Plan, insurers would have some responsibility towards that. How would that be measured?
Thank you. Thank you, Chair Lieber. And I did want to say it's nice to see you too, beyond the wave. That is something that definitely, I say real-time conversations that my staff here at the Department of Insurance, we are having with the FAIR Plan management, executive management, and the FAIR Plan governing committee, because that is very important. Absolutely. I mean, we every year, just for one data point, is every year, the department, we do receive the amount of policies that the FAIR Plan has for its for the fire dwelling side. So essentially on the personal line side, we would want to expand that, of course, for the commercial line side of the FAIR Plan. And so that could be, as just a general thought, is of course we've known for the past several years what the private dwelling is, which, as we know, and you'll hear more later from the FAIR Plan, we've seen the upticks, but we have the actual hard data directly from the FAIR Plan. And So we can look at that and look at, of course, the number of filings coming in that trigger that use cat modeling and or reinsurance, depopulate, lift and shift out of the FAIR plan element. Because our thought, just against conceptual, is that talking to insurers when they file is, what are you looking at in regard to numbers and at the FAIR plan? We can tie that up with the FAIR plan and talking with them of seeing. Part of the hope is then the downward shift of these numbers, and so the details are being worked out. The legislature and the commissioner actually sponsoring one of those bills and strongly supporting another bill. We created in statute 2 clearinghouse programs for the fire dwelling and the commercial. And so those clearinghouse programs, in essence, are the structure, if you will, the mechanism in which folks will be lifted and shifted out from the FAIR plan back into the admitted market. The structure in place, it's really just getting it up and running now, and a lot of it's in the details. We're not here at the Department of Insurance, we're the regulator, not the FAIR plan, but working in partnership with the FAIR plan, in which they are again, and thinking of how to be able to implement that mechanism and ensure that we have the metrics in place to monitor and make sure it's doing what we are believed for it to do, of lifting people out from the FAIR plan back into the admitted market.
And just one follow-on question, if I may. So would consumers be protected, or are they currently protected in terms of if they're coming off of the FAIR plan and seeking insurance elsewhere, or would insurers be able to say, well, if you were on the FAIR plan and you had the insurance of last resort, then we're not going to be able to take you? Is there anything that protects consumers in that scenario?
Chair Lieber, I want to make sure I understand your question. You're wanting to ensure that under the strategy that individuals or policyholders, FAIR plan policyholders, maybe if I not paraphrase what I think I heard, if you can restate, I really want to understand your question.
So if policyholders who are currently under the FAIR plan want to go back in the marketplace and seek other insurance, is there any protection for them in terms of being denied other coverage because they've been on the FAIR plan?
Okay. I would say, I'm not going to have the legalistic answer to that. I'm happy to follow up on that. I believe that, at least just overall, is that individuals that are moving from the FAIR plan back into the admitted market, that is the goal here. We do not want them to go back into the FAIR plan. And so I hear you on, I guess that would be something that we would want to, as we fashion and hammer out the sustainable insurance strategy, that is something that we hear you as you know, an interested stakeholder, that would be something that we would want to have as part of the discussion as we move forward with our rulemakings. Because I hear you, and that's something that we'll need to find that balance of ensuring that individuals in the admitted market continue to and have that admitted insurance market coverage and protection of being in the admitted market, that they aren't going back to the FAIR plan, and then balance of that the Department of Insurance, we do not regulate the underwriting guidelines of an insurance company. And so that is something where we will, as part of these, shall we say, the commitment of the no less than 85%, that's something that could be part of that conversation, that element of our strategy.
Thank you. That would be very, very helpful, because I know that that's part of the terror of what our constituents are going through, is that if you've had a lapse in coverage and you do not have continuous coverage, then it becomes difficult to get coverage. And so I'd be very curious to see if they're discriminated against in any way by virtue of having been in the FAIR Plan. Thank you.
Good questions.
Great,
Thank
thank
you. I'd like to now move to Deputy Controller Imran. You've got some
Thank you.
questions.
Thank you, Vice Chair Gaines. First, want to recognize you, Vice Chair Gaines, for your leadership on this issue. I think you offer such a unique perspective, somebody that's worked in the insurance industry on the private side and in such a distinguished career in the public sector. So thank you for that, and thank you for bringing this together this morning. And also to Mr. Martinez, I want to thank you for being here, representing a constitutional officer. I think many decades ago, Californians understood in what is one of the most valuable insurance markets in the entire world, that having an elected office representing our consumers is very, very important here and stepping up in a time of crisis. Decades of inaction, and particularly on climate change, is causing the property insurance market to buckle under competing pressures to provide returns to shareholders and sell a product that policyholders can actually afford. As businesses, insurers have an obligation to their shareholders to turn a profit. I get that. But as an elected body here at the Board of Equalization representing 40 million people, we have an obligation to correct for market failures when there is a compelling public policy reason to do so. And here is to ensure families can afford necessary coverage and prevent collapses in our local housing markets. Because between wildfires, droughts, flooding, earthquakes, the reality is that there's nowhere left in California that is not prone to climate change. So it leads to my first question on the 85% threshold for the written policy commitments. Can you explain how you got to that number in the distressed areas, and if there still is a protection gap?
So that is something that, as we all know, in a negotiated, agreed upon conceptual agreement, that the 85% was arrived at with all the parties, and the parties being between the insurance commissioner, and I'm talking about, since Senator Ben Allen had in his testimony had alluded to it in his remarks, that this has been that there have been very good conversations in the legislature last year, summer and into the, I guess, like, well, last year, early mid last year, around all of this, and in conversations with the admitted insurance market of what they would bear of, and that's where the number came, 85%. No less than 85% of their market share to be located in distressed areas of the state. And so if you look at, just to your point, if let's say 100% of their market share be in distressed areas of the state, again, we have to be mindful of, as stated in my testimony, is that insurance private corporations. And so we would also need to find that balance for them being able to make a reasonable margin. And in turn, since rates under Proposition 103 are prior approved by the insurance commissioner and the Department of Insurance, that they are justified, that again, their rates being requested are justified by our experts, and thus approved, that the 85% was something that we felt that we all the parties in this being a negotiated agreement, believe that would be something that would be workable. Still, again, a big stretch, because believe me, that we had pushed very hard to ensure that consumers were protected, are protected throughout this process, and in this negotiated agreement. And so 85%, again, is what we all, in order to move forward. Because the thing here too, in closing, is that we, if anyone, can propose an idea, yet if it just falls flat, and because again, under existing law, and there's no essentially Department of Insurance across the nation that in essence can force an insurance company to write in a particular area, or write a particular coverage, that the balance here is understanding that, as well as having some way of, in essence, some mandate with the no less than 85%, in order to, if an insurance company wants to utilize either CAT modeling and or reinsurance in their rates submitted to the department.
Understandable. Thank you. My next and very last question is, what do we as a board tell our constituents, Californians, who are having their plans canceled, rising premiums, limited coverage, because they're feeling squeezed, and constituents want to know when will they see some relief in terms of whether that be a year or 2 years or 5 years, because Californians ultimately need to plan out and budget their lives.
I would say that as what we have conveyed is that we have a plan. We are aggressively working to have it be implemented by the end of this year, and we are working to get insurance companies back to writing more in the state of California. And again, we are doing today of getting filings in and out. We are tackling this reliability and availability challenge here in our state. For more of the details as conveyed to the chair, I will have staff follow up with more details, as well as documents and messaging that you can in turn share and utilize with your constituents, that outreach to your offices, because absolutely we want to, I've said many times as I've talked and provided testimony on the sustainable insurance strategy, we're in this together, and together we can get through this. We can get the insurance marketplace back on track for our constituents, for our consumers. And so we want to be as transparent as possible in the strategic work that we're doing here at the department. So in turn, arm you all to be able to inform your constituents of what's happening here, as well as provide them avenues for public participation if they so choose.
I sincerely hope so. Thank you for your time again today. Mr. Vice Chair, I yield back.
Great, thank you, Deputy Controller. Member Vasquez, you had a question?
Yes, I had a couple, but he's answered some of my questions now, but
Yeah.
just one last one. First of all, thank you, Deputy Martinez, for your presentation, and especially how you conveyed the commissioner a lot of this core strategy here. I just had one quick question on, I'm wondering, does the department have any preliminary information yet regarding possible impacts on the insurance tax on gross premiums?
I hear you. Thank you for your question. I personally do not, yet we do have our premium tax office and within the Department of Insurance. And so if that's a deeper dive conversation between staff, your staff, our staff, then we can have that. But I will not be able to answer your question here today.
Not a problem. Thank you.
Great, thank you so much, Chief Deputy Insurance Commissioner. Appreciate you taking the time, taking all these questions. I know it's not easy. We're in crisis mode, but appreciate what you're doing, the Insurance Commissioner is doing, and your able civil servants. We've got a lot of sharp people over there, so
thank you, sir.
we encourage you, and we just hope that we can solve this crisis as soon as possible.
Yes, absolutely. Completely the same page. Thank you for this opportunity, and we will absolutely be in touch and communication.
Wonderful.
Thank
Great.
you.
Thank you. We will now move on to our next segment of the agenda, and that is Cornelius Burke, who is the Vice President of Government Affairs for the CBIA. Mr. Burke, thank you.
Good morning, Vice Chair Gaines.
Good morning.
Chair Lieber, members of the Board of Equalization. Cornelius Burke, Vice President of Government Affairs for the California Building Industry Association. And first and foremost, just thank you for the opportunity to discuss the condominium and homeowners insurance crisis and its negative impact on housing. Just as background, CBIA, the California Building Industry Association, is a statewide trade association representing 3,000 member companies involved in the residential construction, light commercial construction. Our members, our companies, are responsible for about close to 90% of the homes built in California. As we all know, California is a good place to live, work, and play, and own a home or rent a home. And We're delighted to be part of the conversation today, and our members are delighted to be in California building great housing. Just by way of background, and Deputy Insurance Commissioner Martinez highlighted some of these key issues, but I'll talk about it from a housing perspective. California insurance companies are leaving the condominium homeowners insurance market for California homes, most acutely for condominiums. You know, condominiums are attached communities and are having to turn to the non-admitted or the secondary unregulated market that's unregulated by the California Department of Insurance. And it's the only alternative for coverage, or in the case of single-family homes, they have to rely on the Fair Access to Insurance Requirements Plan, as we talked about the FAIR Plan. So really, homeowners are kind of stuck here. Some, single-family homes can access the FAIR Plan, but it's only as a last resort, and condominiums are unable to utilize the FAIR Plan as is currently structured. Without an increase to the commercial limits, the FAIR Plan is simply not available to those who need it the most. Condominium associations need commercial coverage due to their collective size. And we talked about the impacts on condos. Just from a housing perspective, a land use planning perspective, the state of California's policies are actually trying to drive housing production to be more attached products. There's been a lot of bills in the legislature, there's been a lot of grants to local governments to discourage single-family construction and actually push more condos. So once again, the state of California's policies are pushing more attached products, but the way the FAIR Plan is structured, the way this insurance crisis is going on, is actually making it very more difficult for condos and attached products. So that's one thing just to highlight. The issue for us is that condos and some single-family homeowners are unable to get insurance coverage from the primary insurance market, which is the admitted carriers, and as a result, in the charge of excessive premiums in the unregulated, non-admitted, or secondary insurance market, is causing major concerns and hurting our constituents, your constituents' pocketbooks. For example, premiums for a condo association went from $40,000 per year for full coverage to a premium exceeding $2.5 million per year, which was that resulted in a homeowners association HOA due increase of over $1,000 a month. That is a massive, major increase. That is impacting California's pocketbook. And that's just one example. Another example is that, a condo community ultimately paid over $1 million for partial coverage, and HOA dues increased by $500 per month. Literally, millions of Californians stand to be negatively impacted due to insurance costs. And the case studies show the gravity of the situations. California's condos and homeowners are facing an insurance crisis today, and as we heard from the Department of Insurance and from your comments today, we have to act rapidly. At CBIA, we do have some solutions to this crisis. We're in a housing crisis, and we need to build as much housing as we can, but now we're in an insurance crisis, and they're both kind of working together to cause a major crisis for Californians, especially when it comes to their pocketbooks. We believe to remedy the residential insurance crisis, there needs to be immediate short-term solutions so that those who are currently being priced out of the market can find a reasonable insurance option, and also long-term solutions. So there needs to be a pathway to bring admitted insurers back to the marketplace here in California. In the short term, we need to increase the FAIR Plan's commercial insurance limits. Currently, the FAIR Plan only covers up to $20 million in individual commercial risk per location, which means most condo associations cannot use the FAIR Plan as the coverage needed exceeds this gap. The FAIR Plan's commercial coverage should be increased to at least $20 million per individual structure. This increase in coverage should be done temporarily while admitted insurers work with the Department of Insurance on ways to provide insurance coverage. Fortunately for us, AB 2996 by Assemblymember Alvarez, introduced a couple days ago, seeks to address this issue and really helps to revamp the FAIR Plan in that regard. In the long term, we have a lot of work ahead of us. We need to urge admitted carriers to work with the commissioner to develop adequate and predictable rates. As we all know, in business, we need certainty. And right now, it's a lot of uncertainty in the insurance marketplace. Allowing a moderate rate increase to admitted carriers is a more palatable solution to bring insurers back to the insurance marketplace than paying excessive premiums to non-admitted carriers. This solution requires insurers to individually come up to the Department of Insurance and identify the types of changes to state-approved rates that will bring them back to the condo and home market. This process needs to be expedited as quickly as possible, while still, of course, allowing for consumer input. As the Department of Insurance indicated, there's a robust stakeholder process, but we have to move quickly. Delay hurts consumers today, and solutions are needed immediately. I just also want to just highlight another solution to this problem, and it's not being talked about, and we want to definitely make sure it's brought up today because we think it's one of the top solutions to this problem, and that is that new construction, particularly in master plan communities, is a proven solution. The CAL FIRE maps to identify fire hazard zones do not show that significant mitigation measures employed by new construction and master plan communities is a solution to this problem. Homes built since 2010 in master plan communities and are built in the WUI, which the Wildland Urban Interface, with building codes in the WUI standards, have not burned down in any major wildfire. Furthermore, in all of the last 9 largest wildfires in California, new homes accounted for less than 1% of the homes destroyed or damaged. This is attributed to the success of the combination of tougher fire building code standards, ongoing maintenance of defensible space through HOAs, and the Department of Forestry and Fire Prevention's development standards. New construction helps. It has been proven that new homes and master plan communities help resist the spread of wildfire within residential areas by decreasing home-to-home spread and ember intrusion-based spread. Just in conclusion, I know we're running out of time. I just want to, from the bottom of our heart, as home builders, thank you, Vice Chair Gaines, Chair Lieber, and members of the Board of Equalization for this hearing today. We look forward to working with you, the Department of Insurance, the governor, and the legislature to address the insurance crisis, and of course, continue to build more housing so we can address our housing crisis as well. Thank you so much.
Thank you so much, Mr. Burke.
Gaines, before we continue, can I just make one quick little announcement?
Yes, please.
If you don't mind. A little housekeeping. The closed captioning services is moving to the YouTube closed captioning services for the next 15 minutes. We apologize for any inconvenience. Thank you.
Okay, thank you. Questions? Yes, Madam Chair Lieber.
Thank you. Thank you so much. Well, I just wanted to thank you, Mr. Burke, for being here today and raising this issue. There have been an increasing number of major carriers that are non-renewing, and it really leaves people in that very precarious position. And having been a local elected official, I see how many cities are really making a best effort at their RENA numbers by having compact attached housing that's linked to transit. We need that to address the environmental challenges. And so I really hope that the department does not lose sight of that kind of product as they're looking at the wildfire situation, because there are non-renewals in areas that are not part of the wildfire situation. And somehow the market was functioning before for this type of housing, particularly after the legislature, I think it was about 20 years ago, maybe even 25 years ago, took a pass at looking at the construction of units and et cetera. And then the market functioned for 20 years, and all of a sudden it's off the tracks. So I doff my hat to you for raising this because it's a very important part of the conversation. Thank you.
Thank you so much, Chair Lieber. And I just want to add that you know, as a urban planner myself, you know, I also taught on the faculty at USC in the School of Public Policy there, and in their urban planning program, they really stress the 15-minute city where you want to build close to transit, you want to have more attached product, and coincidentally enough, the hardest product to get insurance for is the condo and attached product. So we have to move quickly because most of the transportation grants, most of the grants are given to cities for housing is for this product type, but yet the premiums and the ability to find insurance doesn't exist. So it makes no sense. It's actually like the state's wasting its own money and planning and resources to force this type of land use planning when there's no insurance for that product type. So it is an urgency for us.
Thank you so much, Deputy Controller Amron.
Thank you, Vice Chair, and Mr. Burke. I want to thank you again for your presentation today. So rising insurance costs undermine the future of affordable properties and those that currently provide affordable homes to our most vulnerable residents. If the trend continues, do you believe affordable housing providers may be forced out of the affordable housing market space because of insurance and operating costs outpacing allowable rents? And how would you go ahead and correct that market imbalance?
Absolutely. I mean, this is really impacting housing, market rate housing, affordable housing, all types of housing, particularly attached product as well. We do have solutions, as I highlighted, and I'm happy to definitely continue to share it with your office and definitely the controller as well. So I can provide a more thorough kind of step-by-step analysis of some solutions we have for affordable housing products, but it's impacting market rate and affordable, but I'll definitely follow up with you on more specific ways we could address affordable housing.
I appreciate that. I have one last question here is on manufactured housing. And the idea is that, I mean, there's data that shows manufactured homes pay more for actually lower quality homeowners insurance. There's about 1.5 million Californians that live in manufactured homes. So why the differential treatment here?
You know, it's a great question. I'll have to get back to you on that answer. You know, my membership, we don't build a lot of manufactured housing, but I'll definitely follow with you offline on that.
Thank you, Mr. Burke and Mr. Vice Chair. I yield back.
Wonderful. Thank you. Member Schaefer, do you have any questions? Okay, wonderful. And Member Vasquez, do you have any questions?
Just one quick one. Thank you for your presentation, and in listening to your comments, I know in the past the whole construction defect has been a real issue, especially with condos, right? And I'm sure this is now even worse as it's moving forward. I was just wondering what, if any, suggestions or possible policy issues that your group has raised that might be helpful moving forward as we hopefully come up with some more recommendations from our end.
Yeah, absolutely. And construction defect is a big challenge. So actually, in a weird way, as I talked about, the states want to push more of this product type for housing, but the construction defect makes it very difficult, particularly in our state. It's something that I know there's conversation in the legislature about this year. We do have concerns that there are individuals who want to open up the law to make it more negative for homeowners and make it more advantageous for the legal community who operate a lot in this space. So as it is, the status quo we think works for construction defect law, but we do want to make improvements to it. But if we do open up, we want to make sure that it doesn't hurt consumers, particularly homeowners. So there is some fear on our part that any change to the law could make it more advantageous for trial lawyers who might want to be ambulance chasers for condo folks.
Okay. Well, thank you so much, Mr. Burke. I appreciate your presentation. I think we've answered the questions, and we've got real challenges in the condo arena. Just as a closing remark, I had heard that there's a builder that has a completed complex that he can't get the insurance for. He's got people that have already put their down payments or their deposits down, can't sell the units to them because the insurance cost is so astronomical, they couldn't afford it. They would foreclose on their condos. So that is a pretty good indication of the challenges we have, and I'm hoping that we'll get some relief through Fair Plan. so that you can insure higher valued properties.
Thank you. Time is of the essence. Thank you so much,
Yes,
members of
right.
BoE. Thank you.
Wonderful, thank you. All right, the next speaker we have is Victoria Roach, and she is the president of the California Fair Plan, and I believe we're going to watch her on Zoom.
Yeah, she is.
Okay. Thank you, Vice Chair Gaines. And
Yeah,
thank
how are you?
Chair Whitaker, for having me here. I appreciate the opportunity to address you this morning. I have a short presentation and then would be happy to address any questions.
Thank you so
Do you
much.
have the PowerPoint there? Do you have the deck that we prepared?
Yeah, it looks okay. It looks like we're pulling it up now, so if you give us just
Okay,
a
great.
minute till that's showing on our screens, and then we can move forward.
Okay, perfect. We can jump right into the next slide. So I am the current president of the California Fair Plan. I've been in my role for about 2 years. I've been with the Fair Plan for about 4.5 years now, and came from the insurance industry 30 years plus with another carrier. So lots of experience in the voluntary market, and about 4.5 years with the, as I said, with the Fair Plan, the insurer of last resort, which, as you've heard this morning, is not really the last resort anyway at this time, but for a lot of people, the only resort out there. So a little bit of background just so we level set who the Fair Plan is and why we're here. So the Fair Plan was established in 1968 by the legislature as a result of the Watts riots in LA. People were having a hard time getting insurance, and insurance companies didn't want to write in those areas. So they established the Fair Plan to provide insurance there. Subsequent wildfires in the Southern California area made it necessary to expand the Fair Plan to certain wildfire areas to offer insurance. And then finally, we were expanded to the entire state to anybody who could not get insurance. The code is very clear as to what is to provide, and that's to assure stability in the market for property insurance across the state, to assure the availability of basic property insurance, and to encourage maximum use in obtaining basic property insurance in a normal insurance market. What that means is, if you look at the right-hand side, the way that this was set up is that people would go to one of the 118 insurers in the state that are admitted carriers to get insurance. Wasn't available to them, they would move on to the surplus lines carriers, and if insurance wasn't available there, they would come to the Fair Plan. As you heard this morning, in a lot of areas we're the only ones writing insurance, and so this has kind of been turned upside down right now. So if we move on to the next slide. So the Fair Plan is not really an insurance company by definition, but we're an association because we are made up of all insurers in the state, the admitted or have property insurance on their books. They back us financially. We are not a state agency, and we are not state or taxpayer funded. We operate as a not-for-profit. We are regulated heavily by the state. The legislation sets forth our statute, but we are not subject to Prop 103. It's a separate statute for us that sets up how the association works. We do accept properties regardless of wildfire exposure, which really sets us apart from the voluntary market. We don't say, oh, we have enough exposure in this area, therefore we're not going to write any more policies here. That would be contrary. Is here to provide insurance where people can't get insurance somewhere else. And we are funded primarily through the policies that we sell to our customers. As you heard today, one of the concerns in the voluntary market right now is that we won't have enough money, and if we have a catastrophe, we'll be in the position where we'll need to assess the market. And so that is one of the concerns. And as we go through what's happening with the FAIR plan, we'll refer back to that, as that's really key to the discussion here, is how do we make sure that we're mitigating that risk of assessment to the industry so that we can create that stability that we're supposed to support. So if we go to the next slide. So these are where our goals and focus is. I look at this picture on the left and I think of somewhere like a Costco. And if they were the only Costco in the state, what that line would look like to get into Costco. That's kind of where we are right now. So our focus really is making sure people have access to that basic property coverage in the state, and meeting the increasing consumer demands. And those demands continue to increase every month. We haven't seen the slowdown that we typically would see seasonally. We know we have a fragile insurance market. And so how closely with the CDI, the legislature, and other stakeholders to stabilize the market. Ultimately, our goal is to depopulate the FAIR plan. So if we move on to the next slide, we can see really what is happening today. And the Deputy Commissioner went through some of our numbers. These are our latest and greatest numbers through the end of Q3. But we are now one of the primary property insurers in California. We have more than 350,000 policies, which is a 22% increase in the last year. We are still today receiving nearly 1,000 applications each of the work days during the month. So well over 20,000 applications in a given month. Really telling is our registered agents and brokers and producers that are writing business with us. In May of 2023, we had around 9,000 registered brokers in our system. We now have more than 54,000 registered licensed users in our system today to write business. And so you can see that we've got quite a number of people that are writing the FAIR plan for the first time, quite a number of people where the FAIR plan is the only option they have out there, right? So in response to that, of course, we've done a lot of increasing our staff internally in both, particularly underwriting and customer service, to be able to meet this on growth. Sorry, excuse me. If we look at the next slide, this talks a little bit about the concentration of risk that we have here at the FAIR plan. So more and more Californians today are turning to the FAIR plan, right? Some of that is directly related to the risk of climate-driven wildfires, and there's just areas where other insurers, based on rate or concentration of risk or whatever their needs are unable to provide coverage. And then really what we're seeing today is the supply and demand issues in California, where a lot of areas and a lot of companies just aren't writing business. So because we cover a significantly higher concentration of high-risk policies, our rate should be higher than what the traditional market is. And if you can look at the bottom picture, you can see kind of how it works for us, right? The voluntary market can pick and choose which policies they're going to offer and where they're going to offer coverage in terms of managing their risk, right? So that they don't have a lot of exposure in some of these higher risk areas because of the way the FAIR plan is set up and our role in do that. And so we pick up a lot of high risk properties in the same area. Today, as of December 31st, our total risk exposure was over $311 billion throughout the state. That's compared to 2018, when we had $50 billion in exposure. So the growth has been exponential. And I will say the growth in the last 7 months has been even more quick than it has in the prior years. So we were growing at a pretty high rate anyway. And then when the market shifted middle of 2023, that growth continued to escalate. So if we move on to the next slide. This slide gives you an idea of where some of that $311 billion of exposure is in terms of concentration of risk. So this map depicts the 5 areas in Northern California that have the highest concentration of risk, and the 5 areas in Southern California that have the highest concentration of risk. And when we look, and you look at Lake Arrowhead, which is and continues to be our highest concentration of exposure, you can see we have almost $8.5 billion worth of exposure in Lake Arrowhead alone. That's not all of Lake Arrowhead. That's taking a circle, cutting it into 4, and taking that southwest part of the circle and that southwest part of the circle, 7 miles from the center of the circle to the edge. That's what we're looking at. And we picked the southwest because that's how the winds blow and that's how the fire, God forbid, in their would spread. And so when you look at that, 2 things I want to point out is, one, in the last year, that exposure has grown 13%. And 2 is we in Lake Arrowhead. So our market share is just over 50% when you look at risk count. So other insurance companies have risks in Lake Arrowhead, but we have more than 50% of the risks in that Lake Arrowhead area. The other thing is, and this map is by no means to scale, when you look at some of these areas, Running Springs, Crestline, Big Bear Lake, Big Bear City, a lot of these, if God forbid there was a fire in those areas, it's going to spread to the other areas. Those are very close areas on top of each other. So we have to continue to look at that exposure and say, okay, if there's how are we going to pay for those losses? And we don't carry a capital layer of $8.5 billion to pay for those losses, right? If you look at an area like Truckee, which has $4 billion of exposure, that area's grown 42% since 2022. I mean, huge growth in some of these areas. So you can see where we're growing, and Northern California is definitely where we're getting a lot of our new business coming in, and we're continuing now through January and into February. So our numbers continue to grow. Okay, if we move to the next slide. So if we look at our rates and our reinsurance, the FAIR Plan rates by statute need to be actuarially sound. So basically that just means we should be taking in enough money to pay our projected operating expenses and losses. We do file our rates with the Department of Insurance, and we have an actuarial firm that we use to go through and look at our rates and look at what we need moving forward, and submit those to the Department of Insurance. We are authorized by the California Insurance Code to purchase reinsurance, and you heard the Deputy Commissioner talk about reinsurance and how that plays into rate making. Today, we do not include the cost of reinsurance in our rates because the department has not allowed it. And with that, it means our rates are not adequate going forward. So if we move to the next slide, you can see that the legislature has addressed this. This was following our last assessment, which was following the Northridge quake. And they're the ones who made the change in the statute to say that our rates needed to be actuarially sound. And the reason for that is if they're not, and we don't have money to pay our claims and our operating expenses, and that means that at some point somewhere, everybody in the state who has insurance is going to end up subsidizing those people who have insurance with the FAIR Plan, the people who are in areas, the people who are secondary homeowners in some of these areas. Somebody has to pay when those losses happen. And if we don't have the money, that then goes to the industry. And that's part of what the sustainable insurance strategy is trying to address, is this concern with the industry over potential assessments in the event of a wildfire. If we move to the next slide. So what are we doing? We're really at this point trying to focus on meeting evolving customer needs. So we did launch a new technology system earlier, well, late in 2023. And any company that has changed their IT system out will tell you that there's always issues when that happens. And like every other company, we experienced some glitches as we went through the transition. We purposely chose the fourth quarter because seasonally that's the lightest in terms of new business and changes to policies coming through. And the decision to launch this new system happened, well, we started a couple of years ago in accordance with the CDI in terms of making sure that we could respond to consumer needs and that we had the systems in place to make changes to what we were offering. And so we have had some issues. We've had complaints. I'm sure there's some of you here have heard those complaints. I'm happy to report things are stabilizing. We are issuing looking at most of our applications within our 5 business day goal, and moving back to a more stable environment. A lot of that has been just hiring new people and getting people up to speed and adjusting our processes, because with this influx of new business, each month it continues to grow and we continue to need to adjust. And we just weren't set up to handle this kind of surge in business at one time. And so that's what we're concentrating on. We're hosting and participating in educational webinars, town hall meetings, and events for brokers, agents, and consumers and other stakeholders to try to help everybody understand where we are and what we're trying to do to address the consumer needs. As I said, we've increased staffing, we're enhancing training and resources. We did make some changes with our last filing that went into effect December 1st, and one of those was to move to Zesty AI's wildfire risk tool. That allows us to take into consideration wildfire risk mitigation that consumers have taken on their property, rather than just looking at the overall kind of zip code level, what's the fire access and all of that, to give people credit for structures that are more resistant to wildfire. We've launched additional policyholder payment options, so we now have a monthly payment plan, and we've implemented online credit card payment options. A lot of this wouldn't have been available had we not changed our computer system. So it's all parallel as we're going through this. If we go to the next slide. So this is a little bit of what the Deputy Commissioner was talking about and what we're writing with the Department of Insurance on their sustainable insurance strategy. We're looking at depopulation of the FAIR plan. The Deputy Commissioner talked about the clearinghouse. We are looking at how to, we are expanding the clearinghouse to include commercial, and we're looking at ways to enhance those processes to make it easier for companies as they re-enter the market to take policies from the FAIR plan and move them back out into the voluntary market. We're talking with them about adequate rates and changing the rate structure to include things like the net cost to bring insurance and cap modeling as we do our next rate filing, and then looking overall at FAIR plan sustainability. So I know we talked a couple times today already about the increased commercial limits that the condo associations are again looking at all of these pieces, and we're balancing them with the sustainability of the FAIR plan to make sure that as we make decisions and move forward, that we are protecting the policyholders that we have today, which again is over 350,000, and that we are mitigating any risk of assessment for the industry so we can create that stability to get these risks back out of the FAIR Plan where they belong. So with that, thank you for allowing me to share the FAIR Plan history and kind of where we are today. I appreciate.
Well, that's great. Thank you so much, Ms. Roach. We really appreciate it. And do we have questions? All right, Chair Lieber.
Predictably. I had a question. Mr. Burke was talking with us from CBIA about the per building limit in terms of claims that could be made, and he talked about potentially raising that. And what is it right now?
No, I'm sorry, I lost you for a minute there.
Oh, I'm sorry. What's the current per building limit in claims under the FAIR Plan?
So we don't have a per building limit. We have a policy limit of $20 million. So the policy limit is by location. We just increased that $20 million in the fourth quarter of 2023. So that was by agreement with the Department of Insurance. We talked about the need for offering higher limits in the state and agreed to a $20 million per location, which means one condo association is a location, and we'll offer $20 million, and they can split that up amongst the multiple buildings however they need to. They just schedule that.
Okay, great. And I had asked the department if there were any protections for folks who are on the FAIR Plan and are looking to go out into the market in general. Is there anything that protects consumers who have been on the FAIR Plan in terms of seeking other insurance?
So there's nothing from our side from the FAIR Plan in particular, that would prevent them from going to look for other insurance. And if they go out to look for other insurance or they go a time without insurance, those aren't factors we would take into consideration to bring them back into the FAIR Plan if they needed to come back to the FAIR Plan. You'd have to talk to the voluntary market to find out if there's any concerns on their end.
Okay. And so the FAIR Plan does accept consumers in that have had a lapse in coverage. If they've never been in the FAIR Plan before and they've had a lapse, they can still come into the FAIR Plan.
Yes, we don't look at prior coverage. We'll ask them if they have private coverage, just so we're collecting the information, but it's not a underwriting factor for us. So it doesn't have any bearing on the rates or whether or not they can get coverage with the FAIR Plan.
Okay, thank you.
All right, Deputy Controller Emran.
Thank you, Mr. Vice Chair. Ms. Roach, on behalf of the Controller, I just want to thank you for stepping up, you and your entire organization in a time of crisis, and really doing a really good job in such a short amount of time. The California FAIR Plan is supposed to serve as a safety net, like you said, but it unfortunately has become a first option for many Californians, which alters its purpose and can have devastating consequences. If the FAIR Plan experiences a massive loss and cannot pay its claims by law, insurance companies are on the hook for the unpaid FAIR Plan losses. Is that true? And can you explain a little bit further about that?
Sure. Yes. So the way it works is, if we have a catastrophe, we project our losses going forward. We look at what our exposure is in the areas where the fire map is, and we look at our operating expenses. And when we get to a point where we say we anticipate we're going to have more losses coming in than we have money that we can pay out in claims, we go to there's steps we go through. So we go to our accounting committee, which is made up of member companies, and we talk to them and present the financials. If they're in agreement, we take it to our board. Our board has to vote that yes, an assessment is the right approach, and they agree that we're going to run out of money and we're going to need more money to move forward and to pay claims. And then we go to the commissioner, and the commissioner has to sign off on any assessment before we can actually assess the member companies. Then we send out that assessment to the member companies. It's based on their market share 2 years prior to this year, so we'd be looking at 2022, what their market share was in 2022, and we would look and we would send out an assessment to them, and they would have the funds.
Thank you, Mrs. Roach. And I know also in the state of Florida, they've also been getting very, very hit by climate change, and they also have it's called a citizens insurance, which is very similar to the FAIR Plan. And all those two different approaches, I just want to thank you and recognize you for your very important work. And I hope that in the future, the FAIR Plan can slide back to being a last option, not a first option, as was intended when originally constructed. So thank you so much.
Thank you. That's our goal too.
Wonderful. Member Schaefer, any questions?
Yes, thank you, Member Gaines. Mr. Roach, do you have an opportunity to confer with or meet with Fair Plan people in other jurisdictions around the country to see if we could teach them something or learn something from them and similar problems?
We do. We actually have a trade of sorts that we belong to, and we meet at least once a year, all the presidents of the different FAIR Plans across the country. But we communicate pretty regularly. And in fact, we have been in communication with several of the residual markets and their states to talk about things they've tried to do in terms of depopulation, what's worked, what hasn't worked, so we could put together some options to work with the Department of Insurance to depopulate as the voluntary market becomes more stable again.
Thank you. And also, I'm very impressed that your application workload would be hitting 1,000 applications a day. I just wondered, how large a staff do you have to deal with that? You must have an army.
I wish we did. So we have about 300 people right now. About 75 of those are temporary employees. So we've grown. We ended last year at about 185. So we've added staff, but we're trying to add temporary. We're talking to some of our counterparts in other states to share resources. So as we hit catastrophes at different times during the year, we can share resources. We want to make sure that we're also prepared for when the regulations go into place and the voluntary insurers get back into the market, that we can reduce staff where we need to reduce staff quickly. So we're looking for outside services to help us supplement.
What happens if you deny an application? Do they have a chance for a review same day by a supervisor? I would hope there will not be much delay in getting a review of a denial.
They don't deny very many applications. We try not to. We try to write what we can. And actually, with our last rate filing, we've changed our underwriting guidelines to really limit the risk that we would not write. So our goal is to write as much as we can or need to help sustain stability in the market and help the consumers who can't get insurance somewhere else. And so we put some rate plans into place with the Department of Insurance to allow us to do that. If we do deny insurance, yes, they can appeal. If they don't like our answer, or don't agree with our answer, I should say, if they don't agree with our answer, and we do have a supervisor look at it, if they lodge a complaint or they escalate up, we'll have the supervisor and our vice president of underwriting take a look at it. If they still don't agree with our decision, they have the ability to appeal to an underwriting committee. That committee is made up of both our staff and people from our member companies. If the underwriting committee says they agree with the original decision by the FAIR Plan, the consumer can appeal to our board. If the board supports the decision, they can further appeal directly to the commissioner.
Thank you. And I've heard criticism over the years that insurance industry is in the business of collecting premiums and denying claims. That's not necessarily so, but we do have a public relations opportunity, and I'm sure you're aware of that. And I do appreciate very much everything you're doing to invoke confidence in the insurance industry in our state. Thank you.
Thank you. Appreciate that.
Thank you. Now move to Member Vasquez. Questions?
Actually, she answered my question.
Oh, okay.
Yeah. Thank you, Ben. Thank you just for your presentation, and you were very knowledgeable, and I appreciate the information.
Thanks for having me.
I'm just before we conclude, how is the fair plan financially? I mean, if we had a catastrophic loss, do we have enough in reserve, or would you have to go back to the insurers in California to pay for a claim?
No pun intended, that's the $1 million question, right? Unfortunately, I don't have a straight answer. We're in a better financial position than we were 2 years ago. We are, if we had a catastrophe today, it really would just depend on the size and the magnitude. And part of what happens is when you have one catastrophe, it's usually not just one is going on, right? When you have those conditions that wildfires grow in, you have multiple fires at the same time. And so depending on how those fires hit, where they are, and how much exposure we have, it really would come down to the size and the size of the exposure we have in those areas, whether or not we'd have to assess. So it's not a straight answer because I really don't have one. There's no magic number.
Well, thank you. I appreciate that. And would it be possible for the members to get a copy of the PowerPoint?
Yes.
Wonderful. Yeah, that'd be great, because there's a lot of information there that I think would be
You
helpful.
already have a copy, it's been distributed.
Oh, okay. Good. Excellent. Well,
Look, I
you're way
solved
ahead of
that
me.
problem.
That's right. Yeah, well, thanks so much, Victoria Roach. Appreciate a great presentation and providing a lot of clarity for us, and appreciate what you're doing. You're going way above and beyond the original intent, but that's what we need right now to help provide coverage for folks, and we're hoping they'll return to the normal market when things stabilize.
Absolutely. Thank you so much for having me.
Great, thank you. All right, let's see. Next on the agenda is we've got Bill Evans, President of the Placer County Association of Realtors, talking about the insurance crisis as it relates to the real estate market. How are you, Bill?
Good afternoon. Can you hear me?
I can, thank you.
Very good. I'm currently, but I'm still serving on the board of directors. I'm also a California Association of Realtors director for our Region 3. Today I speak to this body about what's going on. I'm branch manager of an office in Auburn with 76 agents. Insurance became a big issue for us a little over 3 years ago when a friend called me from Pollock Pines and said that she had just gotten a notice of non-renewal, and that evidently the majority of homeowners in Pollock Pines were getting notices of non-renewal. Pollock Pines is in El Dorado County above Placerville. It said it's causing a shift in the market. And I do a lot of market analysis, and the market I analyzed over a 2-month period of time went from a traditional seller's market where it was, which is 3 months of inventory based on closed sales, went to a buyer's market in less than 2 months. It was obviously, people were dropping prices. We have a lot of fixed income residents in that area, as exists in much of the foothills. And so people started putting a lot of houses on the market, changed to a buyer's market. That has now stabilized more to a neutral market. She sold her 2 houses and moved to Montana. So I'm not a doom and gloom kind of guy, but it got me to start paying attention to the insurance challenges that we faced over the years. And so we put together a regional insurance task force to try to address it from different stakeholders to get better understanding of what's going on in our marketplace. So we've all heard the stories. If I can, I don't have a PowerPoint. Mine's more what's going on in the field. So if I could share those. One of my friends was non-renewed. She lived in Colfax. She did all of the work that was required based on the original letter was for her not, she didn't take care of certain issues on her property. She did more than that. Feet defensible space, a metal roof, fire hydrant, 2 ways in and out of her property. So she had more than complied. Actually, the local fire department had looked at staging on her property. Her and 2 of her neighbors had done very similar things, but unfortunately another neighbor had done nothing. And there was a great deal of overgrowth, different flammable materials on their property, some natural, some not. And when the Colfax fire hit, that property, the neighbor property, went up so hot and fast that my friend Katie and 2 of her neighbors lost their homes, burnt to the ground. So it was pretty devastating having someone who's a fire survivor going through. And we have talked, I've listened all today about what goes on with the plan and the process. She was in the FAIR plan. As it turned out, they did finally, even after she had done the work, the insurance company dropped her. So she had to go to the FAIR plan. And it was fortunate it was not a catastrophe. It did take her over a year to get through the process and rebuild her house. So we're seeing, part of the challenge I'm seeing is the housing affordability in the state of California, which is at an all-time low. The rural communities used to be part of the solution. People could drive a little further to work or could retire here. But now with the cost of insurance, it's made it far less affordable. So one of my friends is in the lending industry. So I asked him to do an analysis of the impact of the changes in policies cost on what that affects in the buying power of consumers. So we're averaging, depending on what kind of policies we're looking at, a $50,000 to $140,000 difference in what your buying power is. Mm-hmm. We have had because they qualified for everything, but when they got the quote for the insurance, adding it to the overall cost of their principal interest, they could not qualify at that point. To that measure, when we were at our winter meetings down in Monterey for CAR, we discussed the challenges within the regions throughout the state. And over 70% of the regions in the state of California are reporting challenges with insurance. Not just as I face here, over 90 to 95% of what we see here in our marketplace plan. But throughout the state, we're not just seeing FAIR plan, but we're seeing what appears to be a knock-on effect of other policies having gone up, whether it's investment property in non-risk areas or low-risk areas, not just high and very high wildfire. So I'm hearing from a lot of people, because I've been vocal about, we all have to work together to get this solved. So people come to me and say that they're having challenges with just traditional insurance. And so it appears that, I don't know if it's a risk sharing or a spreading of risk across the normal markets to offset the high risk markets. But just something I would want to share with you, this is going on throughout the state. So it's obviously a concern to us. We've made changes to our upcoming real estate purchase agreement. Now insurance will be a category that has to be satisfied within the contract. Before it was within our inspection contingencies. Now it's a specific category because it's become such a issue of contention. What else can I share with you? We just had one recently in a developed neighborhood, rather nice home, 3,800 square feet, but it's a curb gutter, fire hydrant, close proximity to the fire station. The quote was $12,000 for the premium. The first buyer canceled. Another buyer came in to take a look at the property, wrote an offer, but they also were kind of shocked by the premium, and the seller ended up crediting the premium cost in the value of the property. So for what it's worth, we're seeing this in a very real day-to-day basis. Almost everything is FAIR plan in our world with a wrap, and it's not as good a quality coverage, but at a far greater price. So for what that's worth, one of the come up with in the group we have, all of the things that we're working on that collectively people are working on are great. What we believe has to take place in a grassroots effort is we have to organize communities, where it's not just one house, and we're not seeing a whole lot of discounts. When we do find good properties that have done the proper defensible space and fire hardening, they're not seeing the discounts that we hear are out there. And they're kind of falling under the overlay of a map versus an actual on-site inspection to say, yes, this property quality is involved, and we can help them realize a better rate, a far safer environment for property and life. We believe fire-wise and fire-safe communities are the key to solving the problem, to bring the insurance and the risk down. So that's our perspective from where we're coming from in a very real world. We're living with this every day. So I welcome any questions.
Thank you, Mr. Evans. Mr. Emron, question?
Thank you, Mr. Evans. I appreciate your very, very unique perspective. I believe in Placer County, and just want to thank you for all your service in this part of the state. You mentioned it quite a bit in your presentation about these efforts around preventing wildfires, specifically home hardening, where responsible homeowners who have made substantial investments to harden and upgrade their properties. You mentioned a little bit cleaning up flammable debris and vegetation around your properties, having certain types of roofs and vents and windows. What are some ways we can encourage insurers and residents to incorporate incentives when they're working around their property and when insurers also setting their premiums?
That's a great question. I think a lot of people, it's awareness. And there's so many people that approach us, they tell us the story that someone is giving them a non-renewal. What do we do? Some people are limited either by age or their ability or financially to do some of the work needed for fire hardening. Part of the solution is, I don't know if we could create a fund that could help those people that are challenged economically. Some people literally cannot afford their insurance. The challenge we're going to face is I looked at a statistic the other day, we have over 10,000 residences in Placer County that are owned free and clear. So there's no mandate that says they have to have insurance. And as we saw in the Paradise Fire, a number of people who own their properties did not have insurance, and they were devastated. So how to solve the whole problem, I haven't figured it all out. I believe fire-wise and making sure the whole community is involved. Then we have to take into consideration what's a reasonable discount for a safe home and a safe neighborhood. But it has to be, I believe it has to be neighborhood-wide. It cannot be house by house. I don't, and the enforcement side of it from CAL FIRE, we need to be looking at what it takes to some of the properties that are out there to be targeted to say, you have so much time to get your property cleaned up. If you don't have the funds, then we'll figure that out, even if that means we have to do the work and then lien the property. Otherwise, we're looking at, one property burns and two don't. I don't understand. It's kind of like playing checkers.
Thank you, Mr. Evans. You bring up a really good point, and I also, and the controller too, understand that these are costly projects which simply people cannot afford, all while paying your insurance rates as well. So should the state of California examine tax-free incentives to assist people in strengthening their homes from wildfires, which helps reduce costs and bring down costs around the property as well? Because the idea is if you invest $1 on the front end, it may help save a home, and in the long run, it saves money because there's emergency funds. You need $5, $6, $7 on the back end to help during an emergency, correct?
I agree. That would be amazing. And, and I think we have to educate the consumers. Part of that is going to have to come from enforcement as well. So I think we have to work with our partners out in the world. CAL FIRE knows the challenges we're facing. I don't know if that's a staffing issue. I think we have some ideas around what could be done to help broaden that scope of how many homes could be inspected. So we've worked at it we're trying to work at it from a solution-oriented perspective, but there's so much that's out of our control. We're just trying to help bring awareness that people can make a difference if they get together and.
Thank you, Mr. Evans. I agree with you 100%. If this board maybe can explore a partnership with CAL FIRE in regards to those home hardening type of mitigation efforts. Thank you so much, and thank you for your presentation and time today.
Wonderful. Chair Lieber.
Thank you.
Thank you. I really appreciate you being here today, Mr. Evans. And You're bringing up some sides of this issue that I had not thought about the difficulty of selling a home that can't be insured for less than $1,000 a month. And I've definitely seen among my constituents many times where someone isn't selling their home just because they want to, but because they have to move to a care home, or there's been a death in the family and finances are tighter than they were. And oftentimes people are really strapped when they're in that position of needing to sell. So I'm very pleased to hear that CAR is going to, and already is, a part of these discussions at the state level. I think that's really essential. So thank you.
Thank you.
Wonderful. Let's see, Member Schaefer, you have any questions? Okay, and Member Vasquez.
Thank you, Vice Chair, and thank you, Mr. Evans, for your presentation. I was just, and you were mentioning several of the folks, especially I guess up in Placerville, have, they just own their homes outright, so they really don't have a requirement for homeowner insurance. But I'm wondering if any of them are able to obtain like umbrella policies, 'cause I know those are really a challenge these days, even in areas that are not in the wildfire areas.
Yeah, it's a challenge. We've seen some people that it's a challenge between medication and certain life choices versus insurance. And it's just kind of heartbreaking. But, the biggest challenge for me ever since I came into the business decades ago was the value of owning real estate and the wealth accumulation that can happen from owning real estate is, I think, critical to the underpinning of our state and our country. And we're now the threat that we're limiting people entering that market and not having that ability to create a future for themselves and and who follow them. It's very concerning. And so it's driven us to continue to work, and I'd love to work with this body in any way we can to help find the solutions. So there's some real challenging situations, and we've had a number of people leave the state. We've seen it. We sold their homes and helped them relocate to whether it's Idaho or Montana or Wyoming. It's been a method, or we've seen that pattern.
Thank you. I appreciate your comments and looking forward to a working relationship here in the future.
Yeah, I really appreciate it, Mr. Evans, for giving us the perspective on, how property valuation can be impacted as a result of insurance. And I've heard a lot of stories in my own county. I'm in El Dorado, where people are going bare. They can't afford it, so their home is paid off. And I really worry about, a big fire coming through and taking what may be their only asset. So thank you. Thanks for raising the issue of CAL FIRE. If I look at my agenda here, maybe that's another party that we should have included, because I know they're making great strides too and targeting fires and getting at them quickly and getting them out so that they don't turn into something more catastrophic. But that will be for another day.
Vice Chair, if I could share with
Sure.
you, I'm working with friends of mine in El Dorado County. I used to live in El Dorado County. I'm now in Placer County. The Board of Supervisors is currently entertaining a point of sale for, as well as compliance with what's called for in the inspection, and anywhere from a 90 to 180 day window post close of escrow. The challenge with it is, as I understand it from friends that had attended the meetings, there's about 5 to 6 qualified people to do those inspections for the whole county. And the size of El Dorado County, from El Dorado Hills all the way up to Tahoe.
Yeah.
And on the basic turn rate of houses, when I did the first analysis, about 150 homes are closing escrow in El Dorado County on a monthly basis. That will increase as spring and summer unfold. If it stops the marketplace and people being able to move forward on acquiring homes, it'll be devastating to El Dorado County. And because lenders aren't going to be able to hold the lock on their interest rates on loans that are approved from closed escrow if they don't know how to fix what's called for in the report. So we not only have the The initial inspection, they'll need to be conducted, but then the work will have to be completed. I don't see anyone closing escrow if they don't know what the work will cost. I don't think any reasonable person would, nor would a professional in the business. So it's a concern. And if we see this, what I think what's happening is, and I think no one has or bad intention. I think everyone's trying to come at this from a different angle, seeing what they can do to change things. We saw vegetation ordinances in Placerville. I know Auburn is looking at some of their own ordinances to try to address the issues that we're talking about today. So just to bring it to the attention, it becomes more unwieldy, and it's costly for the value of real estate. And so people will just say, I can live where I can live, and there's other choices. So
Yes,
for what
great.
it's worth.
Yeah, thank you. Bill Evans, president of PCAR, appreciate your input, and we'll now move forward. Looks like we are ready for a break. Is that 15 minutes? Is that
15-minute break.
appropriate? And
Yeah.
other comments, excuse me.
Just before we go on our break, I wanted to make sure that we've announced publicly that the Veterans Work Group that was to meet this afternoon has been put over. And so we will let folks know via the website what the future date of the Veterans Work Group is, but it will not be held today. So thank you.
Yeah, thanks for clarifying that. Wonderful. So we're going to, okay. Yeah, we've got Rex Frazier here, but we also have a break. I
Yeah.
think it's important to
We
take
could
the
just-
break, though,
yes.
isn't it? Because we've got staff.
You could just ask them to.
Well, yeah,
Yeah.
yeah. Mr. Frazier, Rex, can you wait 15 minutes
sir.
for a break?
Oh, of course, not a problem at all.
Thank you so much.
Thank
It's
you so
it's
much.
really key for our staff. They need to have those times. Thank you. So we will reconvene. What would that be?
12:35.
About 12:35?
12:35.
Great, thank you.